A big misconception right now too is, when a person is purchasing a home, everyone always assumes that 5% down is under a first-time home buyer incentive. It's not.
Look, I get it. The Toronto real estate market is confusing. Whether you're a new or experienced investor or just looking for a home to raise your family in, join us at Broadview Table Talks as we sit around the table with my friends and talk about the real estate and the ever-changing market in Toronto.
All right, guys, welcome to another edition of Broadview Table Talks. I am here with my buddy Ryan Dennahower, the boss. Ryan, Ryan, the mortgage guy. What's going on, man?
How are you, buddy? Thanks for having me.
Yeah, thanks for coming. So you come to talk about the issues that we're seeing in the mortgage market right now, where activity has dropped by like 50%.
Yeah,
but you're still saying it's a good time to get into the market.
I would have to say so. Yeah. There's some opportunities out there. For sure. You're entering the market at a, in some cases, decreased values, right? Which is a good thing. And again, too, right now, depending on what you're looking for, it could be a right fit for you, right? Property specific, first time buyers, investors. I think that, again, too, obviously dealing with someone that kind of has like your goals in mind, right? It could be a fit and it could not, right? Everyone's different.
Right. So now that carrying costs are so much higher, we've been saying this for a long time that yes, prices probably will drop, but the carrying cost is going to go higher. And that's all a result of the interest rates, right? So somebody trying to get into the market now is looking at it and they're like thinking, oh, wait, maybe now is not a good time. Even though prices are down by like 19% or whatever, 15%, depending on which market you're looking at.
Yep.
Carrying costs is like double or like a lot higher anyway.
Yep.
Maybe not quite double, but like it's a lot higher because interest rates are much higher, 425 basis points or whatever it is,
yes.
Has gone up by, right?
Yes.
So what would you say for somebody that has been thinking about a first time buying their first home or investing in their first property? What would they do to get in the market? How should they think? Like what? Tell me some strategies.
Great question. So one, do your homework, right? Again, doesn't cost you anything to reach out to a mortgage professional and run some options, right? In some cases, you don't even have to complete a mortgage application, right? A couple questions, income, debt, down payment. We clearly spit out a couple options to you. So, 5 minutes, right? So explore your options just because, again, too, there are different options for everyone. Right. A lot of times too, depending on, what your wants and needs are, I think just getting into the market some way, somehow could be a benefit. Looking at, again, too, anything is cyclical, real estate market, stocks, our weight, right?
Right. Yours just goes down. I don't know. Yeah.
So, you look at it and again, too, we're on a downturn right now, and everything for the most part as a whole, right? If we fast forward 2 years, 4 years, 5 years, what's that going to look like then? Right. And again, I know that we hear this from a lot of people, but, I would say I'm very optimistic, simple supply and demand. Right. Last year, I think there was, the number is 700,000 people coming into Canada.
There's more.
Yeah. And that was 2022, 2023. I think they're forecasting it could be closer to 1 million people coming into Canada, right? People like our good friend Benjamin Tal always says they're not coming in with a house on their back, right?
Yeah, you saw that podcast too, right? Yeah, that was a good one.
Right? They need somewhere to live, right? So again, too, what does that forecast? If there's not enough houses and people now want to start buying, and again, too, if affordability gets better, it could only now signal that more people are going to come out and purchase, right? So, my advice is, understand what you qualify for. Come up with a game plan, right? If you, if you don't put together a plan, like you're automatically gonna fail. Or if you just assume that you don't qualify, you're never really gonna know, right? So I know you and I were discussing earlier, but online they make it really easy, right? You input a couple of numbers, it spits out a mortgage approval amount in 2 seconds. Take that with a grain of salt. Right. Getting on the phone and speaking to a human and a mortgage professional that knows what they're doing could really, provide you with, a sense of either a opportunity, right? Or again, a plan to get you to where you want to be.
I was just thinking about this. Maybe some of our listeners don't understand how the process actually works. Mm-hmm. So when they're calling you as a mortgage broker, first of all, why you versus the bank? Yep. And then second of all, when they call you guys, what happens there? It goes to the underwriter. Like, how do they process it? How do they approve of it? What are they looking at?
Yeah. So again, too, I give a very detailed answer, but I'll try to sum it up.
CDS,
absolutely,
basic, yeah.
Absolutely. So as a mortgage broker, all we do is service mortgages, right? All that we do is obtain mortgage approvals. That's our job. Okay. So with that being said, what we look at is to qualify for a mortgage, really 3 things simplified that we look for: income, down payment, credit history. right? And those three things will now determine the max mortgage that you qualify for. So we gather all that. In terms of my office's process is we'll take that at first verbally, right? So you don't have to commit to an application. You don't have to commit to giving documents. We'll have a very quick verbal conversation. Won't even check credit just to see if there's an option, right? Is there a light at the end of the tunnel?
Because every situation is different.
Absolutely. If it looks positive, let's start now. Right. So now let's collect the application, and on the application, personal details. Okay. There's some information that we need: personal details, address history, job details, etc. Right. And a couple of income documents to support, right, what it is that you're stating that you're making. If you're salaried, if you're self-employed, okay, there's different documents required. We now get that. And now with that, we now qualify you. How do we qualify you? Again, to your income and your debts determine how much of a mortgage you qualify for. Right. And we look at monthly obligations. So what people need to understand is, again, a car payment, for example, right? A $400 car payment in today's day and age with today's rates, it essentially is equal to an $80,000 mortgage approval. Right. So if you have, and I don't think I've seen a $400 car payment in a very long time. So let's call it an $800 car payment. That's $160,000 in mortgage approval. Right. So knowing those things, either A, before you buy the car or before you turn in your lease to get another one, if there's a home purchase, in the horizon, right, anywhere from, 6 months, 1 year, 2 years down the road, you want to be cautious, right? Because again, too, it can affect you.
Yeah, so you get your home first and then do the mortgage,
absolutely,
the car approval, because car approvals are less stringent, right?
Absolutely.
So, yeah,
absolutely.
Mortgage approvals are a lot higher. The amount is a lot higher. So.
Definitely. So we gather that, we put together options, right? And then the main difference between a broker and a bank, you have access to one product, right? A broker, we have access to multiple products. So we actually work with a lot of the banks as well, right? We work with the banks, but then if you don't fit in that bank's box, instead of us telling you, no, we're sorry, you don't qualify, or hey, why don't you just show more income, or whatever the case may be, we have other lenders that we can go to potentially get you qualified. So again, no missed opportunities, right?
Great thing.
We send it, we send it off for an approval afterwards. The approval come back, it's conditional, right? And what I mean by conditional is when we submit something to a bank for an approval, what ends up happening is, again, it comes back and it says, now provide us with proof that the income is X, the down payment is X, these conditions are signed off. We have a conditional period where we can get all those conditions, signed off, lead up to your closing date. The mortgage now closes. Now, the best part of all is when the mortgage closes, again, you have a point of contact with that bank, right? Online login. Maybe there's someone there that was assigned to you to take care of your mortgage. But what we do is we, again, like to stay, in close contact with our clients, right? So again, you can contact myself, my office, anything from payment changes to just an update on interest rates to, an opportunity. Were you in a variable? Does it make sense to go fixed now? Are you in a high rate fixed? Does it make sense to break and go into a lower rate fixed? So again, we'll always look at those opportunities for everyone.
So options are great. And I would say that it's kind of annoying to have to give it a separate application. If you go to all the different banks, like the big 5 banks or whatever, it's like you feel like you're just undressing for them. You know what I mean? It's so like intrusive to give that information. I'd rather give it one person, find the best product and go from there. Right. So that's just my personal thing. So back to the process, when you're talking to the underwriters at the banks, do you actually get to talk to them, or you talk to a BDM over there, like a business development manager, or who do you talk to?
Yeah. So again, multiple points of contacts there, right? So again, BDMs, business development managers, these are individuals that really want you as a mortgage broker to send your clients to that specific bank, right? So again, they are, big on, education and why this bank over another bank or this lender over another lender. So BDMs, we have a contact to. A lot of the banks that we work with, we do have designated underwriters specifically for, our brokerage. So again, we could talk to the source, right away, which is helpful. You have that open dialogue to actually go and walk through a deal. Again, just to make sure, and I know I'm saying this, I think for the third time now, no missed opportunities,
sure,
right? Because again, sometimes if you don't have that communication, right, there could be an opportunity where something was, again, just, misinformed, or it came out the wrong way, where if you were able to explain it, again, an approval is there. Right. And, perfect example. And, we'll probably run through a couple of these scenarios, afterwards. But, recently there was a situation where, based off reported income of a client that we were working with, they essentially qualified for a $600,000 mortgage. They needed a $900,000 mortgage. They were self-employed
because appraisal values went down.
Correct. No, not even appraisal values, qualifying. So again, I'm sure a lot of realtors can relate to this. You were able to now incorporate, right, and show income incorporation. Although you've been a realtor for 10 years, for 5 years, and you have a history of this income, bank policy is now when you become incorporated or you're newly self-employed, you need a 2-year average of your income to qualify. In this case, they only had 1 year of financials. And that 1 year that they reported personally, they didn't report the same income that they were when they were a sole proprietor. So for our listeners listening, let's just say you're a commission-based individual, you're earning $300,000 a year. After expenses, you made $200,000. Now, when you incorporate that $300,000 goes into your corporation, maybe you only need $60,000 of personal living expenses. So you only paid yourself $60,000. Yes, you made the same income. Banks don't look at it that way because there's not a 2-year average. So they now qualify you on the 60.
That's right.
So in this case, we're able to get on the phone with an underwriter at a big bank, right? Explain the scenario, back up with proof that it's still the same income, just the way it was filed. And we're able to secure that $900,000 mortgage approval for them, again, at best interest rates in today's day and age, right?
Sure. So the reason why you're saying those online approvals are not so good and to be relied upon is because you're talking to an underwriter. The underwriter is the person stamping the mortgage because their job is to protect the lender, to protect the bank for not underwriting bad deals where they're likely going to default because they don't want defaults. The default ratio is really low in Canada. So you have that side, but then you have the BDM side that want to push business. They're trying to get you to bring business over. So it's kind of like conflicting. I totally get it. Yeah. And it's a tough job, but for the lender anyway. So
absolutely.
Yeah. Okay. So I don't know. With that, show me some examples. Like what's the most complex example you've come across?
Oh, we've seen it all, right? I would say in today's day and age for, individuals that have purchased and are looking at refinance options now after a year or a year and a half and values have dropped, right? They now have the option to just refinance with their existing lender. They are, somewhat handcuffed to that one lender. So there are options out there that people could potentially explore, to refinance under, higher loan to values to prevent them from going to foreclosure or something along those lines, right? So again, I think a big thing in today's day and age is going to be rent to own programs. And they were impossible in the past, right? Just because again, firm offers, right? $300,000 over ask, it just wasn't happening. Now we are starting to see on our end a lot more conditional offers. Right. We're able to breathe a little bit because clients are putting in offers. We have 5 days to secure financing. It's nice. We have time to secure options.
It's a short lived though. I think it's going to come back. The bidding wars are coming back.
I agree. For sure. I agree. But this opportunity is there where a rent to own could come into play is again rent to own is not only purchase, perfect example. If you had, poor credit right now, your only option to purchase is 20% down. Right. But if you want to get in now, maybe a good time knowing that. Again, there is a potential for price appreciation over the next 1, 2, 3 years. With rent own, you could actually get in with 5% down, right? And I think that this is an option that people need to start talking about more and explore. Full disclosure, we haven't done a lot of them, but again, looking at the opportunities that are coming up, I think that this is going to be a big win for a lot of individuals. One, going back to the original, if your mortgage is coming up for renewal, you either have the opportunity to renew or instead of, being forced to sell your home, you could look at a rent to own program, anywhere from 85 to 90% loan to value, right? And then again, there's obviously a lot of fine print. I won't get into too many details there. If people are interested, feel free to reach out. But I think that's a big one. And that's a very complex thing.
I disagree. I don't like rent to own programs, first of all, as an investor or as a borrower.
Yep.
First of all, as a borrower, you have to have super high income to be able to afford your rent payments and a bit more to cover this. That's really hard. Rent is so high to begin with in Toronto anyway.
Yep.
Okay. And then as a borrower, as a lender, I find that the issue with that is that you're capping your upside. Why would you do that? Mm-hmm. Why would anybody cap their upside on the appreciation?
Yeah.
Because you're basically guaranteeing to sell it to the purchaser or to the renter at a certain price.
Yes.
But you're using your credit for that.
Yes.
So it doesn't make sense to me. If the government steps in and like they said they were going to do and create these programs, sure. Awesome. But like, I think it's kind of a scam, to be honest. And I don't believe in them personally. I think that if you're in a situation like that, really continue renting, get your stuff together, fix your credit, fix your income, whatever it might be. And then down the line, that's a goal to achieve towards.
Absolutely.
Take full control of that yourself. I personally don't like them.
Okay. So
I could be wrong.
Yeah. Again, like I said, we haven't done a lot of them, but again, we started looking into it when the market was hot.
Yeah.
Okay. It just didn't make sense. And the reason why it didn't make sense is because you need a conditional period to make sure that the investor going on the deal can get the deal done. They like the deal. The client is happy with qualifying and what have you.
But what if it's institutional money? You don't have to worry about that now, right?
Yes.
So that's different. But the problem is, like I said, you're going to cap your upside as an investor.
Yes.
If it goes up by 20% a year again, right?
Yep.
Then you've lost.
So again, rent to own, more so looking at rent to own for a borrower to get into the market, right? Not as an investor. As a borrower, some of the programs that we've seen is, again, too, they do a modest appreciation of 3% a year. Okay.
Who's going to do that?
Okay.
Which lender is going to do that?
There is a lender that we have access to.
Okay.
Right. And again, too happy to share details on it. Right. But I don't want to provide misinformation. But from what I know right now, 3% increase a year. Right now where the market is, okay, if you did this rent to own, let's call it last year prior, okay, it didn't work out. Looking at where everything is trending today, if you have the ability to get into a house, okay, if you're able to afford the carrying costs, okay, with a 3% appreciation with a buyback in 2 years or 3 years, let's just call it 3% a year, okay, the ability for you to fix your credit within 1 to 2 years, depending on your credit situation, right? To have this, I feel that, again, too, depending the way that the market works out, the upside right now looks a lot better than the losses or the downside, right? When we look at this fundamentals, again, too, I'm going to assume that there's other investors out there that structure rent to owns differently. And again, too, maybe we even do another conversation on this when we have more details, because I think it is an opportunity that a lot of people don't talk about just because it wasn't a good opportunity previously.
But it still isn't, is what I'm trying to say. Because look, rental prices, many people are struggling to even pay rent in the first place. So how can you pay rent and principal? Yes. You know what I mean? So that's really hard for a lot of tenants to do that. So I think there's better strategies, like you were saying about earlier, about getting, sister, brother, relative, partners involved in your purchase or guaranteeing the loan. Perhaps doing a insured loan even. So you go less money down and use some of that capital to make your payments as well too. A big misconception right now too is,
when a person is purchasing a home, everyone always assumes that 5% down is under a first-time home buyer incentive. It's not. Okay. You could buy a home one time with 5% down as long as it's owner occupied.
Under 500,000.
Under 500,000.
Right. Yes. So 10% under 100,000, a million, sorry.
10% over the amount above 500,000.
That's right. That's right.
But again, too, if now you went into that home and you stayed there for a year, okay? You stayed there for a year. Again, let's just say right now that everything that the Bank of Canada is doing right now, this time around, is correct. Okay. Interest rates going up, inflation comes down, hopefully. Okay. It starts to come down. Once inflation starts to come down, okay, that is now going to signal that there's going to be interest rate cuts. Okay. Interest rates cuts come down. People's affordability goes up, which now pushes up price points, right? People are qualifying for more money now. Okay. So let's just say that you bought this home. Okay, 5% down. Let's just call for easy numbers here. Okay. 500,000, you put down 25,000. Okay. Now in a year's time, that home, let's just call it's worth 600,000. Okay. You could now sell that home. Okay. You could pull out your capital and you could buy your second home. Let's just call it now. It's for 700,000 with 5% on the first 500, 10% on the remaining 200. So for 45,000, still the minimum down. You're not required for that second home to put down 20%. Okay. As long as it's owner occupied, you can do that again. You could stay there for a year and a half. Mark goes up. You could sell it again and do it again. So there's a big misconception there that, hey, I've already bought a home, or I don't want to buy a home yet because I want to save my first time home buyer status of 5% down. Doesn't make any sense.
Just get in,
right? Just get in, and you could buy, multiple times with owner let's call it minimum down.
Is that legal?
It is.
Okay.
As long as you are owner occupying the property, absolutely.
And they don't care about the one that you already have.
If you sold it, that's completely fine. Again, too, if your family outgrew it, that's completely fine. But again, rules state, as long as it's owner occupied, right, at the time of purchase, minimum down. And I think that's a big opportunity. And that's why a lot of people need to speak to mortgage professionals, right, to actually source out their options.
Okay. So let's talk about the scenario of people that are in, say, a 2-bedroom condo and all of a sudden, or even a 1-bedroom condo, and they have a kid, they're outgrowing that, and they want to trade up in today's market, but the carrying costs are through the roof and it's insane to do that. What would you advise them? Say they had a fixed mortgage 2 years ago, let's say at a really low rate.
I think that there's a huge opportunity. I just said huge. Huge opportunity.
I think these are the ones that are winning the most in this market.
Yes. So again,
but they don't realize that because they're scared of the payments.
Absolutely. So again, too, for those individuals right now that are currently in a fixed rate mortgage from, let's call it a year and a half ago
$1
prior.
million condo. Let's say they bought $1 million 2-bedroom condo.
Yep.
And they want to move to a $2 million house now.
Yep. So the opportunity here is, number one, first thing that you want to do is contact your mortgage provider or a mortgage broker and explore your portability options.
That's right.
Okay. Reason being, if you have an $800,000 mortgage, let's just call it, right, and you locked in 2.5%, let's even call it, 2.5%. Okay. So now if you could port that mortgage over, and depending on your lender's portability options, if you needed to increase that mortgage, you could either blend that new money. So if you need an extra $300,000, you could blend that new money at today's rates. Again, too, we could call it, let's call it 5% money, right? You could blend that 300,000 to that 800,000 to come up with a new blended rate. It's obviously going to be a much lower interest rate than what's being offered today. Yeah. So now with that, if that new blended rate ends up being 3%, 3.5%, we now have to qualify at a stress test rate, a rate that is 2% higher than the contract rate. Okay. So we would now qualify these individuals. Okay. Let's call it at 5.5%. Okay. Opposed to someone getting in today, right? They now get a mortgage for 5%. We have to qualify them at 7%, right? 7.5%, right? Yeah. That severely impacts you on what you qualify for. So you have the ability here to upsize, carry your mortgage over if your lender allows it. And again, every lender is different. So definitely explore your options, but there's a huge opportunity here. Okay. Huge opportunity. So definitely explore that. If you are looking at options, you're scared about interest rates today, and that's why you don't want to make a move because you have a very low rate right now. Yeah. You could upgrade your property. Huge opportunity.
And this especially works for, say, couples, right? So maybe say, you were a single person when you got that 1-bedroom or 2-bedroom, whatever it is. And then all of a sudden you got together with a spouse, which turns out to be a real estate partner because you're basically partnering with them, right? Yep. And then you both qualify for even more. And it just makes so much more sense. Absolutely. You're going to get everything at a 15, 20% discount.
Yes.
Right.
Yes.
From what it was before.
Yep.
And your carrying costs may not be that much. It might be a little bit higher than if you were to buy this, a year ago, let's just say, right? The carrying costs, but you're still going to win in the long run because the fundamentals are going to push the prices back up eventually. When immigration comes in strong, when builders aren't building right now, not as many. There's a lot less project starts right now.
I don't know if this is, I think I've heard
development
stat, like one third of projects right now in GTA have pretty much been like halted or somewhat put on hold, just again, due to financing costs, due to development costs and what have you, right?
Taxes, more increased development levies even.
Yeah.
Right. So we're going to have a planner or architect actually on the next podcast. And he's talking about basically now as of right in Toronto, you're allowed to have 4 units for density, 3 or 4 units, depending on which zoning you're at. And they're basically removing the development charges for that, which normally, the city of Toronto would have gotten 80 grand or whatever per unit, whatever, depending on the size, right? 60 grand or whatever. But they've increased it on larger developments. So basically taking away from the small guys and charging more for the bigger guys.
Wow.
Which is kind of cool. So they're still like net like even, but it just makes sense for the everyday individual to start getting into, multiplex, triplexes, small multiplex investing as well too.
Absolutely.
But the downside of that is that these large condos, they're paying way more in fees, development fees, like huge, like 50% more.
Wow.
So we'll see what happens. Yeah. So the point is that developers are putting these projects on hold because all these costs are escalating.
Yep.
Labor, material, taxes, all that kind of stuff, right? So supply is going to be restricted in the next 5 years. Yet demand is still going through strong.
Yeah. Yep.
What do you think it's going to do to the prices?
They could only do one thing.
Right. So if you can get in the market, I think you should. There's definitely strategies out there. Talk to the boss, Ryan, the mortgage guy. He can help out as well too, based on different scenarios.
Absolutely. Absolutely.
How do they get a hold of you?
Yeah. So again, you could follow me on Instagram, Ryan the Mortgage Guy. You can, email me directly, ryan@bmtgg.ca.
I'm still getting confused this day.
Or again, just message Ken. Ken will share all my details. But again, the biggest thing is, don't be fearful.
Bespoke Mortgage Group.
Bespoke Mortgage Group is the brokerage that I own. And again, don't be fearful of exploring your options. That's the biggest thing, right? A 2-minute phone call. What I've seen from talking to a lot of individuals could change your life, right? In terms of just options provided, or again, just getting you set up and on the right track to buy that property. Whether it's this year, next year, 3 years from now, if owning a property in your lifetime is a goal, getting a head start and putting those things into place ahead of time is the right move.
Okay. All right. Thanks for listening, and see you guys next week.
Thanks for having me, Ken.
Add it up.